somewhere in the Isle of Sodor.
Thomas the Tank Engine! What are you playing at now? I thought you could learn to be more responsible if I sent you to work here.
But sir, this time it's really not my fault.
Oh yes it is. You've clearly been using dead clicks again. You know, if you just use dead clicks for your double entry bookkeeping, it just causes confusion and delay. You need to use the positive money, negative money method. Look, I'll show you. So Thomas, let's go back to where it all began in 5th century India on the banks of the Ganges. Of course they didn't have all those trains back then, and neither did all these fancy terms used nowadays that just cause confusion and delay if students are not careful and think about the underlying bookkeeping. I'm going to take away all of that nonsense, Thomas, and first of all, we're going to focus on where double entry bookkeeping lives. It lives in something called the entity in the general ledger, and that entity exists regardless of the type of company structure. So don't be worrying about sole traders or different types of companies. Just consider the thing called the entity, and it's just got one shareholder. Anything else causes confusion and delay. So we have this thing called the entity. And in this entity, we have money going in, and we have money coming out. So we have positive money, and we have negative money. And each transaction for the company has positive money for the company, or it has negative money for the company. Money does not have to be paid in or out straight away. It represents either cash now or future cash in or out. Now in this money in, money out method, positive money is either an increase in a money in item or a reduction in a money out item. Negative money is either an increase in a money out item or a reduction in a money in item. So we can see how we can have positive money, which can either be a money in item going up, or we can have some money that we thought was going to go out but it's going down. And negative money is an increase in a money out item that's going up, but we could have had some money that we thought was coming in that's actually been reduced, and that's going down. Are you with me so far, Thomas? Now, of course, we could take these money in items and money out items, or this positive money and this negative money, and we can put it on a number line. And in accountancy, we put a number line with our positive numbers to the left and our negative numbers to the right. And so our positive numbers to the left would be a decreasing money out item, or an increasing money in item. A negative number would be an increasing money out item, or a decreasing money in item. So we can have these positives and negatives, and remember, for every transaction, the positive money is always going to be equal to the negative money. Now this is the opposite of a traditional number line, Thomas. The traditional number line was invented in 1700 by John Wallis, a mathematician. But the 15th century Indian merchants got them up there first, and they really invented the number line, and they put it the other way around. So, Thomas, I'm sure now you've already started to give names to these positive money and negative money items. So who's getting this money though? A money in item is held by the company, and that's called an asset. And an asset is either cash or something that will be turned into cash later on. A money out item goes either from the company to either someone who does not own the company, and they're called liabilities. Alternatively, it's going to somebody who owns the company, and some people call them equity, some people call them capital, and some people call that reserves. So every item is either classified as a money in or a money out item, either classified as assets or liability or equity. And so we have this thing where our money in items are always equal to our money out items in the end, and our positive income is always equal to our negative income. So in our assets, if they're increasing, it's going to be a positive number, and if they're reducing, it's a negative number. And in our liabilities plus equity, if they're increasing, it's a negative number, and if they're reducing, it's a positive number. Now, why does this accounting equation always equal assets equals liabilities plus equity? And the reason why is because the equity side is the shareholders, and they can only have whatever's left over after the assets have been taken away from after the liabilities have been taken away from the assets. So they get what's left. And because of that, that is why the money in is always equal to the money out. So we have names for these number directions. Positive figures are called debits, and negative figures are called credits. And this would be the approach in an electronic software system where you would actually see pluses and minuses, unlike you've seen in a manual system. So in this electronic system where we have our positive money, and we also have our negative money and minus money in here, we still have this idea of money out is decreasing. There's a decreasing thing which would be positive. Money out which is increasing would be negative. Money in increasing would be positive. Money out, money in decreasing would be negative. There was positives and credits. Positive would be a debit, and negative would be a credit. So here we can see our full accounting equation with how changes in the money in items and the money out items create debits or credits. And so what we can see here, Thomas, is that if we use the dead click method and we don't actually consider the movement in the money in or the money out item, we actually get our journals wrong half the time. And that is why your trial balance did not balance. You have to consider whether it's a money in item or a money out item first, but then you have to consider the movement before you decide whether it's a debit or a credit. Now in a manual system, we see these things in a T account, and we put our debits on the left and our credits on the right. Debits are our positive figures and they're put on the left, and credits are our negative figures and they're put on the right. And all items are positive. Now in order to get our balance to balance, we have to come up with something called the carry down balance, and then we balance it together, and then we turn that into the brought down balance for the account. So here are our debits, and then here are our credits. The carry down item has to go here, and that is our brought down item. And that is how it would look in a manual system where we don't have any minuses, Thomas. In our electronic system, we can just put them in a single line with our debits being the positive figure and the credit being the negative figure, and see how it comes up with exactly the same balance and carry down as in the manual system. Now, Thomas, we're going to go through some examples then of what happens, just again as a recap, to assets. Assets is a money in item. If it's increasing, that will be positive money for the company. Positive money is equal to a debit, and that will therefore be a plus. Negative or reducing asset is a negative item, and that would be a credit, and so that would be a minus in an electronic system, or it would be on the right in the credit side of a T account. Liabilities would be a money out item. If a liability is reducing, that would be a positive money impact. That would be a debit, and that would be on the left. An increasing liability would be a negative money item, and that would be a credit, and that would be to the right, and that would be a minus. Now, share capital, remember, although it might be great for the shareholders, and it might be great if we make profit, which all of us want to do, especially if we can keep Percy on time. However, all this represents is money out that the shareholders will want. They want their money back. So, if we make profit in there though, then it will be more money to the shareholders, that would be more money out. So that would be increasing our money out item, and that will be a credit. So that is the reason why sales are credits. If there's anything that reduces the money that goes out to our shareholders, like they've already taken some money out in drawings, or we paid them some money, or we have less money because we've made some expenses, that would be a reduction in the money out item. That would be positive money, and so that would be a debit. Now, of course, if you're then thinking about your purchase returns, well, that would be a money out item, but that would be an increasing money out item, because we've gone and had our purchase returns in there, so those share capitals will want their money back, and so that will be a credit. We'll go through some examples now, shall we, after we just concluded this. So, our assets in the balance sheet. In our opening trial balance, they're going to be positive figures, so they'll be debits. But in the journals, there'll be movements backwards and forwards about whether those things are going up or they're going down. So in an opening trial balance, you can use dead click, but in your journals, you cannot, Thomas. Liabilities in the balance sheet, they will be negative money, so they will be a credit in the opening trial balance. But in the journals, they could be moving up or down, and so they could go either way. And shareholder capital in the opening trial balance represents money that will flow out to the shareholders. But in between, in the journals, it could be that we're making expenses or we're making sales, and they could be going up or down. So for journals, these items can move in either direction. They can be either debits or credits, and that, Thomas, is why you cannot use the dead click method. So what I'm going to do now is hand over to my good friend Michael, who's going to take us through some specific examples. Hopefully you work that one out, Thomas. Good luck in the future.